Welcome to Simple Investing Secrets. In today's video, we're going to review the 10 reasons to buy Johnson & Johnson stock in 2023. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Johnson & Johnson, ticker symbol, JNJ, is probably one of the world's most recognizable multinational corporations. The New Brunswick, New Jersey, based company has been in business for more than 130 years and employs over 130,000 individuals. With operations in 60 different countries, it is one of the world's largest health and wellness companies. Johnson & Johnson has been a safety net for many dividend investors for years, and that will continue to be the case in 2022. Johnson & Johnson's biggest strength is its diversified business model. It operates through pharmaceuticals, medical devices, and consumer products divisions. It has about 250 separate companies, which shows that the business is very well diversified. Its diversification helps it withstand economic cycles more effectively. J&J has one of the biggest budgets for research and development among pharmaceutical companies. One reason shares of J&J are up is due to their defensive nature. Since the economy isn't sure what will happen in 2023 and most people expect at least a small recession if we aren't already in one, investors have been flocking to more stable names like J&J. Johnson & Johnson is renowned for its stability, and over the past 3 years, J&J shares have outperformed the S&P 500, albeit by a small margin. That is saying something considering that over the past 3 years, J&J has seen a lot of rough patches in terms of negative press. With that said, let's look at the 10 reasons to buy Johnson & Johnson stock in 2023. Number 10. J&J's stock is dividend royalty. Johnson & Johnson is one of the 48 dividend kings in the United States right now. This is a prestigious list of dividend stocks, and to be on it, you must pay a growing dividend for 50 or more consecutive years. J&J has increased its dividend for 60 consecutive years, making it dividend royalty. As the stock currently trades, shares of J&J pay an annual dividend of $4.52, which equates to a dividend yield of 2.53%. Over the past 5 years, the company has increased the dividend at an average annual rate of 6%. The dividend is well covered with a low payout ratio of 44% and a very strong A-rated balance sheet. However, once the spin-off of its consumer health business takes place in 2023, it will be interesting to see how the dividend plays out. Consumer health will be a stable company, but the growth won't be as strong. On the flip side, the new J&J will now be a faster growing business, and we can see it playing out very similarly to that of AbbVie, which spun off from Abbott Labs about a decade ago, and that would be very intriguing. Number 9. Rapid growth through acquisitions. Another thing that stability and free cash flow allow Johnson & Johnson to do is make acquisitions. Another key part of its future is J&J's medtech business, which includes the company's medical devices. This segment accounts for more than 1/4 of J&J's top line. In October of 2022, the company said it would buy Abiomed, a company that makes medical devices, for $16.6 billion to grow that business unit. Abiomed is known for its Impella heart pumps, which over the past 4 quarters have helped the company generate more than $1 billion in revenue. With this purchase, Johnson & Johnson will be able to offer more medtech products and improve its pipeline in this area. Last quarter, J&J's medtech division's sales of $6.8 billion rose by 2.1% year-over-year. As stated by J&J management in the press release announcing the acquisition, Abiomed operates in one of the fastest growing medtech segments with significant expansion opportunities in indication, geography, and product. The addition of Abiomed's products could speed up that growth rate. Number 8. The company is practically a global healthcare index fund. Johnson & Johnson is not just the largest publicly traded healthcare stock by market cap, it might also be the most diversified. When its sales are broken down by business and geography, it reveals a company with many eggs in many baskets. The company's largest business is pharmaceuticals. Its portfolio of drugs treats everything from cancer and cardiovascular diseases to immunology and infectious diseases. That last category will benefit from its COVID-19 vaccine. Its best-selling drug is Stelara. It was sold for $7.7 billion last year and was used to treat plaque psoriasis and psoriatic arthritis. The drug continues to get approved for new indications, leading to a 15% growth last year. Medical devices account for more than 1/4 of sales and are spread across service lines like orthopedics and vision. Instruments and surgical systems contribute significantly in this area too. Johnson & Johnson has also made a few meaningful acquisitions to bring in new innovative technology. Finally, the consumer health segment is famous for items like Tylenol, Neosporin, and Band-Aids, which accounted for a little more than 1/6 of sales. Similar to its lack of reliance on any one part of healthcare, the company's sales are also spread across the globe. Although the US accounts for a little more than half of total revenue, management claims it operates in just about every country in the world. Number 7. A paycheck and raise you can count on. That diversification provides stability in all kinds of economic cycles. It also helps dampen the effects of any problems in one business unit. The predictability has allowed management to pay increasing dividends for the past 60 years. The 2.6% dividend is respectable. However, thanks to the distribution increases, those who bought 20 years ago will be getting checks this year that amount to 7.7% of their initial investment. That's the power of holding a dividend grower for the long term. Despite that history of growth, the company still has plenty of room to keep raising the payout. It distributed just 62% of earnings last year and 51% of free cash flow. That last measure, the cash dividend payout ratio, has bounced between 50% and 60% for a decade. Not only is the dividend not going anywhere, but management is also not increasing it faster than its ability to pay. That's a conservative approach that should let risk-averse investors sleep well at night. Number 6. J&J expects pharma revenue to hit $60 billion. This healthcare conglomerate does a lot of different things. Its consumer health, pharmaceutical, and medtech businesses bring in billions of dollars each year. Its pharmaceutical division brings in more than half of the company's total sales and is by far its biggest source of income. For the third quarter, which ended September 30, 2022, pharmaceutical revenue totaled $13.2 billion, accounting for 56% of the $23.8 billion in total sales. The pharma segment's Q3 sales grew a modest 2.6% year-over-year. Its top-selling drugs were the psoriasis medication Stelara and the cancer treatment Darzalex, which each managed more than $2 billion in quarterly sales. Annually, the company's pharma revenue over the trailing 12 months was about $53.7 billion. However, J&J expects its annual sales from that segment of its business to exceed $60 billion by 2025, a 12% increase from where it is now. Johnson & Johnson says it has 14 new drug therapies that have the potential to be blockbusters and bring in more than $1 billion each in annual revenue. Some of its most promising products in the drug approval pipeline, including the blood clot medication Milvexian, could top $5 billion annually. These growth projections take into account the fact that revenue from Stelara will go down next year when it is no longer exclusive to the US market. That's a positive sign, as the increase in revenue should help offset the loss of its consumer health business, which Johnson & Johnson plans to spin off into a separate entity in 2023. Number 5. J&J is moving away from consumer health. Long term, it could be very good for J&J's business if it split off its consumer health business. It is a business segment that has had its share of challenges in recent years. Last year, the company issued voluntary recalls on multiple sunscreen products that contain benzene. It is also facing tens of thousands of lawsuits because its talc baby powder contains chemicals that can cause cancer. For a segment that generates the least amount of annual revenue, $14.8 billion over the past 12 months, it may simply not be worth the headaches that come along with it. By spinning off consumer health, Johnson & Johnson's business becomes more focused and efficient. And that focus may offer it more growth potential in the long run. Number 4. J&J is a solid stock with lots of growth potential. A 13% growth rate in its pharma business through 2025 likely isn't going to have growth investors rushing out to buy Johnson & Johnson stock. But in the bigger picture, with the company being more focused on growth and development in its pharma business, that could lead to significant gains down the road. Trading at just 17 times its future profits based on analyst expectations, Johnson & Johnson's valuation is in line with the average healthcare stock. But given that this is one of the top healthcare companies in the world with some exciting growth prospects on the horizon, it's arguably worth more of a premium. Because of its already large size, it will be hard to grow sales exponentially or even double, but Johnson & Johnson does make for a solid growth stock to hold, particularly for risk-averse growth stock investors. Number 3. Johnson & Johnson is a recession-proof stock. There's a lot of talk of a US economic recession at the moment. Depending on who you ask, the answer ranges from certainty to pretty unlikely, but it's a heated debate. Companies are racing to keep pace with rising prices all along their supply chain, a tight labor market, the war in Ukraine, and seemingly never-ending political issues. Johnson & Johnson's business model lends itself to holding up well during a recession. Going back to the fundamental impact of a recession, consumer spending decreasing, we can draw some conclusions about how this could impact different businesses. If money is tight for households, the first items to be taken off the shopping list will be luxuries and unnecessary items. Luxury consumer goods, entertainment and leisure, and other discretionary spending can drop significantly. Fewer people will be in the market for a high-end handbag or a new car if the economy is tanking and they're worried about losing their job. Those same people will still buy Tylenol if they need it. They'll still buy diapers, wipes, and baby powder for their children, and they'll still get a scan at the hospital if the doctor tells them to. The demand for the products that Johnson & Johnson creates is very resistant to changes in the broader economy, and they're also primarily products that we need to keep buying regularly. Johnson & Johnson is known as a safe haven asset during a recession because of its steady level of demand, wide range of products, strong credit rating, and good track record. Number 2. Johnson & Johnson's stock performed well during the last financial crisis. During the 2008 financial crisis, the S&P 500 fell by 54%. Johnson & Johnson wasn't completely safe from the volatility, but their share price fell 21% over the same time period, which was a much better result. But it gets better. During this time, J&J's stock could be seen as a side effect of the general move out of the stock market. Investors were more likely to be dumping their total portfolios rather than specifically selling J&J. The reason to suggest this is because J&J grew their earnings per share and net income every year throughout the 2008 crisis, from 2007 through 2013. Simply put, despite the worst economic downturn since the Great Depression, Johnson & Johnson's business continued to expand and thrive. Importantly for investors, Johnson & Johnson has been able to raise dividends for 60 straight years, through 2021, because it is a stable and long-lasting company. That's almost unheard of. Number 1. J&J Has Brand Power. Part of Johnson & Johnson's success has to do with its successful line of brands. If you've ever bandaged a wound, rinsed your mouth, applied lotion, sanitized your hands, battled a headache, substituted sugar, or treated heartburn, there's a very good chance that you did so courtesy of Johnson & Johnson's research and development. Band-Aid, Listerine, Aveeno, Stay Free, Lubriderm, Visine, Tylenol, Zarbee's, and Bengay are all well-known brands that belong to this company. Marketing is key for the company. It caters to consumers' emotions and sensibilities. For instance, marketing for the Neutrogena brand focuses on the empowerment of women. Johnson & Johnson also promoted Band-Aid products on social media by creating a unique hashtag. This concludes our list of the top 10 reasons to purchase Johnson & Johnson stock in 2023. The company, which is well known throughout the country, will undergo significant changes in 2023 when they separate their operations and create a new company called Kenvue for Consumer Health. Shares in the meantime have been providing stability for investors' portfolios given the uncertainty surrounding the economy in the near term. An investment in J&J is about as reliable as they come because it is a dividend king with a strong portfolio of products and a rare AAA credit rating. Comment below with your thoughts on buying J&J stock in 2023. For weekly updates on the top stocks to buy and cutting-edge investment strategies, don't forget to like this video and subscribe to our channel. Thank you for watching, and good luck with your investments.